Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today and yesterday, because there was not a daily yesterday. And for that, I do apologize. I was having a great deal of technical issues that took a lot of work, and I lost some hair over trying to solve. So anyway, for here today, I have for you the Empire State Manufacturing Index, which went way, way, way down in May, like seriously down. We have industrial production numbers for April, which were quite a ways up from March. We have retail sales numbers, as well as the National Association of Homebuilders Homebuilding Index. So I'm going to try to knock these out in about 5 minutes, tell you a little bit about what these things are and what they're currently doing, at least as recently as April and May. So in order to get started, I'm going to have to go ahead and get out of the way here so I can show you some charts. All right, so we're going to start with the Empire State Manufacturing Index, which, as the name sort of indicates, is an indicator of business conditions for manufacturing firms in the state of New York. It is collected each month by the New York Federal Reserve Bank, which sends out a survey and asks a series of questions about the business conditions and about all kinds of different aspects of the manufacturing business to those firms. And it does cover pretty much every last manufacturing firm within the state. So it's pretty comprehensive. In April, we were sitting at a level of 24.6, which is considered pretty average, actually above average in terms of being expansionary in terms of growth. So that was a good level. But as you could see in May, we dropped way down by 25 points, down to a level of negative 11.6. And as you can see by this red dashed line, if you know anything about the periods where this index was falling off along this series, by the way, this is about 20 years of data since 2001 when the index first began. But if you know anything about these periods, you'll know that this is a pretty contractionary reading as far as this index is concerned. And when I say contraction, I mean indicative of less supply coming off the lines, less things being produced, and less demand for those manufactured goods, which is an indicator that the economy is, at least in New York and maybe its exporting partners in the United States, is probably taking some sort of a hit and is in a state of contraction, which ultimately means that the human standard of living in the U.S. or the state of New York is dropping by a bit. So that's essentially what this indicates. Essentially what this indicator means. And if I could just plug something here real quick, if you want to know more about these dips and troughs and what they are, you can watch my short deep dive that I'm going to be posting later on this evening about this particular indicator, because there were some interesting highlights that I want to make sure and call out from yesterday's reports. But moving on, we have industrial production. Now, this is one of my favorite economic indicators because it's not influenced at all by prices. This is completely based on quantities. It's recorded by the Federal Reserve Bank and has been since 1919, so a very long-run series going over 100 years, which you can't say about most economic indicators. Industrial production hit an all-time high in April, and that was a growth rate of 1.1% from the month before. And if you annualize the last 3 months of growth in industrial production, that comes out to an annual growth rate of about 12%. So this is pretty good growth in industrial production as far as that is concerned. And the previous all-time high, I just wanted to point out, as you can see, it's been pretty hard to get significant growth in this indicator ever since the Great Financial Crisis, which is indicated by this huge trough here. The last all-time high was experienced all the way back 4 years ago in September of 2018. So just wanted to call that out as well. Now moving on to retail sales, this is a chart that is in billions of US dollars, and that's current US dollars, which means not adjusted for inflation. So to give you an idea of what that kind of implies, if let's say the same number of hats in retail establishments were purchased in April as were in March, so you got maybe 1 million hats, and the prices of those hats went up by about 1,000% between March and April, and you took the reading of total retail sales, it would register register that retail sales grew by about 1,000% just because of the price increases alone, even if the same quantity were being purchased. So this indicator is especially sensitive to inflation, and in order to really pull any economic meaning out of it, you do need to adjust it. And so just keeping that in mind, we had 1% growth from March to April, and if you take the 3-month annualized version of that and kind of extend it out, you get 12% annual growth rates, which is pretty good. But again, a lot of this increase was probably due to the inflation that we've been seeing. As you can see, it's spiked quite a bit in the last year and a half since we started to see these large inflation prints. So the last thing that I'm going to point out here is the National Association of Homebuilders Index. This is an index that's designed to gauge the sentiment of the home building industry. The home building industry has to be especially cognizant of what demand for housing is going to be like 6 months to a year down the road, because when they build a house, they need to be pretty confident that there's going to be demand for it on the other side of that project. So this tells us a lot about what the home building industry is going to do, and is a pretty solid indicator for home prices actually as well. So we saw a huge spike throughout the COVID-19 pandemic with the building boom that resulted with all the liquidity that was dumped into the housing market. This is a 35-year chart going all the way back to 1985, and what we see in the last month is a 10% decrease from March to April, and if you annualize that, it's pretty grim. That would translate to about a 59% annualized decrease. So pretty significant changes there. And then lastly, I just want to talk about what I'm going to go over tomorrow. The major indicators that are coming out tomorrow are building permits and housing starts. The third week of the month is especially big for housing data, and that's why it's probably my favorite data week of the month, because I really like housing data, and I think it says a lot about the condition of the economy. So I'm up to 6 minutes and 48 and counting seconds here. I'm going to sign off. I do hope you enjoy the rest of your Tuesday evening, and I'll see you back tomorrow for another edition of Supply and Demand Daily. Thank you very much for joining, and I hope you have a great day. Thanks.